This is the New York Fire Department Pension Fund Investment Meeting. Today is 9/16/2015. It is 10 o'clock. We're at the New York City Controller's Office, 1 Center Street, room 530, New York, New York. We need a roll call of trustees.
Mr. John Adler.
Present.
Mrs. Emma Vickers. Mr. Antonio Rodriguez.
Present. Hold just a second. Can the reporter, did you hear that?
Not so great, but I know who's there.
Okay, all right, okay.
Yeah.
All right, okay.
Mr. Steve Cassidy. And Mr. James Levin.
John Kelly will be here in a minute. He's in traffic.
Okay.
And Mr. Eddie Brown. Mr. John Kelly will be coming shortly. Mr. James McGowan.
Here.
Mr. John Farina.
Here.
Mr. Paul Furrow.
Here.
Mr. Thomas Phelan.
Here.
Commissioner Douglas White.
Here.
We'll have 22 votes and a quorum when we start the meeting.
Okay.
Okay, thank you very much. This is our June quarterly meeting, and I have for you the new quarterly books. It's in the total fund overview. There are a couple pages that have been inserted into your books, and they replace the same page numbers. There were some small technical errors, and so the ones that are inserted are the ones that you should use if we're on those pages. Now, we've revamped this whole quarterly report. As you notice, it's a lot skinnier than previous versions are. And we've taken some liberties in taking out exhibits that we think are duplicative. If we've made a mistake and we've taken out something that you consider vital, please let us know. We'd be happy to put it back into the next section for the next quarterly meeting. But we've heard from many of you that there's just too much material, and so this is an effort to sort of cull it down. In terms of new information, we now have fee information for each of the managers and all the way up to the top of the fund for the first time integrated into the report. So if you turn to page 17, we can begin to look at that. On page 17, you'll see the asset classes, both the total fund up in the top panel, and then all the asset classes broken down. I'll just stay on the top panel for the minute. You can see on line 6 over there on the left, that's the line number, and the other speakers will point you to line numbers. It's just for convenience. $10.9 billion is 100% of the portfolio. On a gross basis, it was up 3 basis points this past quarter, 3.55% for the year. And this is the number we've been used to looking at before, the 3.55. But it is gross of expenses. In the public side, 16 basis points of expenses. You can see down in the first red row. And then 10 basis points in the alternative markets or private markets. The public markets is done. We've got all the managers, and we're confident that we've got the right and accrued expenses. So that number is good. The 10 basis points is partial. And the reason is the invoices come in. Sometimes we have the detail, sometimes we don't have the detail. We are in the process of getting the detail from all of our managers, and as it comes in, we'll be able to feed it into the report. The other thing to note is that the public market is on an accrued basis, which means we've lined up the time periods in terms of the expenses. The private market is on a cash basis, so we might be getting fee charges for multiple time periods that results in lumpy fee results. So we're going to try to get that private markets on an accrual basis as well. And once we do that, we'll have fulsome detail for you. We'll be able to fill out all these rows and all the columns. The ones that we have yet to do are in sort of tan color with red letters. As you go down and we compare, in the case of the fiscal year, we're down to 3.29 net of fees. The benchmark was 4.15. So you can see we're 86 basis points below the benchmark for the June quarter, and for the fiscal year. And then to the left, you can see that for the June quarter, we're actually up 18 basis points, and I'll talk about the details of that in a minute. But as you look across here, the red and green, we use red and green when we've got the expense numbers and you're looking at things that are net of expenses. For the history, because we don't have the data, you're still looking at gross of fees returns, and we keep that in black, either plus or in parentheses and minus. So when you're looking through this report, if the net number is in black, it's still gross of fees. If it's either red or green, it's net of fees. I'll stop there in case there are any questions about the methodology that we're using, because you're going to be looking at this for each of the managers going forward. They're going to use this too.
Yeah, I have a question about this. All right. I can't see the print without the glasses, with the glasses.
Yeah, I'm sorry about that. We did run into a font problem here. We will fix that next time.
My eyes.
When the numbers are better, we
So the private equity, the private real estate, and the infrastructure all have just black numbers down below. So that means that the alternative markets fees in the top panel don't include fees from those asset classes?
Well, no. That's a very good question. Yeah, the question is, when you look at the detail on the private asset classes, they're in black, which means that according to what I just said, we're showing the gross of fees numbers. What we've done is that because we have partial information, John, on these asset classes, and because the information is so lumpy, it throws the data around terrifically. So we have not, on the detailed asset class information for the private asset classes, until we get more data, we haven't brought it down to that level. We're just using it at the top level. In fact, we even contemplated not using it at the top level, but after going back and forth, we realized that would not be appropriate coverage. So we have to show you what we've got. But I think that trying to carry it down to the next level, because it's cash basis data, just gives you such lumpy results that it's difficult to interpret. So if you'll bear with us, we will get there, but when we have more complete data.
Okay.
Okay? I think Doug had a question.
I just wanted to clarify the top line and the numbers that John asked about. Aren't the private equity numbers already shown net? So you haven't grossed them up, right? So the gross number at the top is not. It's a mix of gross and net. Is that right?
Yeah. The top number is gross, and we have when we have the information to go gross and net. We're putting it in the net figure, so that we found 10 basis points of expense in the alternative asset classes. So we do, when we find, so to give you an example, we find new information, it will be added to the gross and the expense. So the net number should remain unchanged, if that answers your question.
Yep, that absolutely does.
Let the record reflect that John Kelly of UFA is present in the meeting.
When we say, fund determination or whatever it is, would you be referring to the fiscal year or the calendar year?
Okay, so when we
Generally speaking, when you say that.
generally speaking, we talk about the fiscal year, in press and so forth. We generally talk in fiscal years. So this fiscal year today is the end of the full year. So the public number for fire, is 3.55 gross and 3.29 net.
So that is after fees.
Correct. Okay, so we're we're partially there. We're there in terms of the public fees. We're working on the private fees. It's there's a little complexity, but we figure we'll show you what we got, and as we get to total transparency, we'll give you the full information on the private market. Okay, let me just quickly do the other stuff that we usually do. If you turn to page 10, I'm going to give you a breakdown of the 18 basis points of excess return for the quarter. It was coming from the selection effect, 15 basis points, as you can see. If you turn to page 13, we can see the breakout of that with private equity giving positive results, hedge funds and opportunistic negative results versus benchmark. So that gives you the breakdown. I will now turn it over to the asset class heads. We'll walk you through the details of this. And then we have additional information, which we're going to give you an executive session in case you have questions in the manager update.
Is there a reason why you want to have the numbers that color here when it's negative, when you do it on the other pages? Like if it's negative
Page 13.
on page 13.
That's a very good question. You can. Yeah, to be consistent. I like that. We'll make it red and green. Good idea. Make another. Okay. Right here. Thank you for that. Very good suggestion. Okay, if there are no further questions, I'm going to turn it over to John Mersberg, who will take you through the equity detail. John?
Thank you, Scott. Good morning, everybody.
Good morning, John.
If you would please turn to page 19 in the report. And the first section on the top of page 19 shows the performance of the U.S. equity composite. The composite had net returns of 1/10 of a basis point for the quarter and 6.43% for the fiscal year. Detractors, they trailed the benchmark by 4 basis points for the quarter and 86 basis points for the fiscal year. Detractors for the fiscal year performance included the small cap value overweight. And if anybody has specific questions about specific managers, I'll talk about that in the executive session. If we move down to the third from last composite, further down the page, it shows that the total developed composite was ahead of the EFA index for both the quarter and the fiscal year by 40 and 66 basis points respectively. I'm sorry, it's line 263, the third composite from the bottom,
Is that on page 19?
on page 19.
This page 19 has got more detail in the assets section.
And if we move to the last composite shown on page 19, total active developed markets composite, you can see that that composite was ahead of the EFA index for both the quarter and the fiscal year, while it was behind the EFA IMI index for the quarter, but ahead of it for the fiscal year. Now, the active developed composite has a slight small cap tilt, while the passive composite has a bit of a large cap tilt. And when the two are combined, it results in a total developed markets composite that is close to the EFA IMI benchmark. FIRE had added an active small cap developed markets managers in May of 2003, and subsequently added a small cap passive allocation in February of 2014. So for the more recent trailing periods, the EFA IMI is the better overall benchmark, while more distant years are best judged versus the EFA index. Next, turning to page 20, the first composite on the top of page 20 shows the performance of the passive index composite, and that composite was ahead of both the EFA and the EFA IMI indexes for both the quarter and the fiscal year.
I'm sorry, the excess return, it's showing the excess return?
Right, one is against the EFA index and one is against the EFA IMI index. And the IMI includes small cap, whereas the regular EFA index is mid and large. And then the next three composites on the page show the three different active developed markets composites. Developed growth trailed for the quarter and year at 48 and 99 basis points respectively. The developed value composite shown next trailed by 1 basis point for the quarter, but was ahead by 170 basis points for the fiscal year, while the next composite, developed small cap active, trailed the benchmark by 9 basis points for the quarter and 249 basis points for the fiscal year. Moving to the third from last composite on page 20, which is line 357, the total emerging markets composite. You can see that it was ahead of the benchmark by 10 basis points for the quarter, but trailed by 97 basis points for the fiscal year. And this was driven by the performance of the active managers, which, as shown in the next composite, were ahead of the benchmark by 9 basis points for the quarter, but trailed by 141 basis points for the fiscal year. And wrapping up the composite at the bottom of page 20, you can see that the passive emerging markets allocation was ahead of the benchmark for both the quarter and the fiscal year by 22 and 27 basis points, respectively. Are there any questions on the public equity portion of this report? If not, I'll hand it over to Yvonne to talk about REITs.
So just some brief comments about the portfolio and its performance. So I'm on page 21, and up at the top of page 21, it's line 387. We see the portfolio has a market value of $340 million, which is about 3% of the portfolio. In terms of performance for the quarter, it was a tough quarter for REITs on an absolute basis, but the FIRE portfolio outpaced its benchmark by 72 basis points, and also for the fiscal year by 59 basis points. As we look to the right for other time periods, you'll see that the FIRE portfolio has exceeded its benchmark in most of those time intervals. So I will like to pass it on to Neil at this point to talk about hedge funds.
All right, so hedge funds is on page 17. And it is the number 67. Sorry, say that again? Yes, 67. So, the hedge funds underperformed in the most recent quarter, and it's a little disappointing. It's the first quarter since we've been in balance that we underperformed against the benchmark. And the reason for this is we're in balance, but our portfolio, our hedge fund portfolio is very, very concentrated. We have about 15 investments in there, and the index is very, very diversified. It has about 250 hedge funds in there. So from time to time, we're going to see this sort of difference in performance from one quarter, during one quarter, and sometimes we get that back in the next quarter. You can, if you do the math here, you can tell that the quarter before we were obviously very ahead, and then this quarter happened. So, that also caused us to underperform the fiscal year to date. You can see that there. We still outperformed the pension itself, but underperformed the hedge fund benchmarks. And that's it for hedge funds. I'm going to turn it over to Robert, who's going to talk to you about fixed income.
Thanks, Neil. Good morning. I'm just going to go over the fixed income performance and the overall weightings. We start on page 18. I think it's line 107. So fixed income is about 32% of the overall plan. And the components of fixed income, we'll start with structured fixed income, which is about 18.5% of the overall plan and 52.5% of just the fixed income portion. So in the structured program, we have an overweight to credit, an overweight to mortgages, and an underweight to governments. And during the second quarter, as Treasury sold off, our weights were beneficial for our performance. So we outperformed in the 3-month period by about 20 basis points. Now that's reversed when you take a look at the overall rally for the fiscal year. As Treasuries rallied, credit didn't do as well, and mortgages kind of was pretty stable there. So as we go down to line 141, which is TIPS. TIPS is about 8% of the overall fixed income allocation. So TIPS, as there was low inflation, it kind of stayed in line and we didn't outperform or underperform. Then we go to enhanced yield, which is about 10.7% of the fixed income allocation, 3.75% of the overall plan. And in the enhanced yield portion, we had some managers who actually bought into bought into energy at the energy commodities and other metals and mining. So that was the cause for the underperformance. We go down to line 161, which is bank loans, which is about 5% of the fixed income portion and about 1.5% of the overall plan. So the bank loans are a short-term instrument with about a 5-year maturity at the max. So in the low rate environment, they've actually done pretty well. And on the last line, which is 171, which is convertibles, which is 1.5% of the overall fixed income plan. We have to work out some details on the benchmark, but the one manager in the convertible composite is actually a more equity-driven, more bond-like driven manager. So it kind of underperformed the other indexes. And I'll turn it over to Wes. Yes. Sure.
So over kind of both the quarter and over the year, even over the 3 years, structured, kind of our structured program has seen a positive kind of allocation effect.
Right.
Is that driven mostly by our kind of overweights to credit and mortgages versus government agency, or is it driven by our underweight to the structured program as a whole? I'm just trying to get a feel for whether which portions are kind of driving that performance.
For the 3-year period?
For the quarter, year, or 3 years, so either
Okay.
one. So they're positive in all of them. And so I
Right.
was wondering which would have been. I believe we've been underweight our structured fixed income for
Right,
quite a while. So.
Quite a while, yes. So as when you see rates drop off, right, as rates sell off, the governments, which is basically most of the rate program in credit, which have a component for rates as well, right, those will actually do better, okay? So you can see in the third quarter as rates sold off, credit and mortgages actually did better, right? And our overweights to credit, because of the spread nature of those products, it actually does much better. So we've actually kept that weighting for those 3 sub-asset classes in structure for quite a while now.
I was wondering whether or not, because while we are overweight 2 portions of the program,
Right.
whether or not it is due to those overweights or our positive allocation, or it's due to the underweight to
Right.
the
It's
program as a whole.
It's a little bit of both, right? So our underweight our overweights they still have a rate component in there, although the duration is much shorter, right? Our longer program in governments has a longer duration. So it's kind of a little mixture of both. It's actually, it was a good call on, when you take a look at the 3 asset classes that make up the structured product, something is going to have to be underweight when you have an overweight. One of the products is the market weight in between. So the 2 overweights that we have aren't as big as the underweight.
Yeah.
So you're right about the underweight being a big benefit to our portfolio. But the overweights do matter somewhat a little bit too. So as they generate some performance there as well. Now, if you need the exact numbers, we could
Oh, yeah,
go
no,
back to
Here's
it.
a good question, Antonio. Let's look at it a little more carefully in terms of the relative importance of being underweight structured versus the performance within structured. It's a good question. There is, as Robert points out, there's performance coming from both, but we actually don't have a mechanism here to evaluate, but it's something we should do certainly back in.
So, okay, so when rates actually drops down, the treasuries dropping down, mortgages kind of held their own. They've actually didn't underperform or outperform by much. They were kind of market driven, market neutral. So that when you take a look at the overall program, it's actually outperforming. So, for example, in the second quarter, I think rates had the government portfolio had about a negative 4% return, right? While the mortgage portfolio was about even. So it was about 50 basis points of negative return. So it's very little, compared to where rates are. Oh, you're welcome. Any other questions? Okay, great. And I'll hand it over to Wes.
We're staying on the same page, 18, just going down to line 181 for a few comments on opportunistic fixed income. For the quarter, opportunistic fixed income underperformed by 253 basis points versus 241, the benchmark. Although there are some individual names that are part of this underperformance, it is mostly due to the preponderance of distressed debt in the energy sector, which Robert mentioned earlier. The good news is that most of these, the vast majority of these losses are unrealized losses, so the story isn't over for these positions. And in the long run, we are still doing pretty well, 9.76 versus the 10% benchmark. And we're entering a credit environment where we're actually being paid to take risk. So I think in the long run, we're going to do quite fine. But definitely energy is an issue in the past 3 months. I'll hand it over now to Brian.
Thank you, everyone. So we're going to go over the ETI portfolio, and we're going to move to this quarterly book, in part because we only have the top line number here in the book, and I like to talk about the individual managers, and I want to keep that going. However, if you'd like more color in the executive session, I can refer to other books, or I could refer to the July book, which is much nicer for us, so I'd love to do that if you wanted to. We're going to start on page 8, where we have our PPAR book. Should look like this. I should note we moved the totals to page 9 in response to some comments from board members that the large chart was getting unreadable because it was getting too small. So bear with us. We're trying to make sure everything's readable. So let me start with the overall portfolio. The ETI portfolio actually underperformed its benchmark by 25 basis points. But over the last 12 months, we've outperformed our portfolio by 74 basis points. What's primarily led that short-term hit for your portfolio is actually the valuation of the PPAR program, which is not actually the coupon rate you're getting from the individual loans, but how much they're valued on the open market. So when we look at the PPAR portfolio, FIRE's PPAR underperformed by 4.44% in the second quarter. That was led to several months of interest rate and government and securities, and we took a big hit. I should note, we've actually made that all up again in July, which shows you that it is the sort of interest rate risk we're seeing. But over the past 12 months, we've outperformed our benchmark by 3.15% over the last year. Oh, sorry. On page, hold on. So I can tell you that in the public book, on page 18, you can see the overall, on 199, the entire PPAR portfolio. However, page 18, the 191, the very last line. Right. And I should note that we've had a unpleasant conversation with our State Street Custodial Bank for accidentally putting the word teachers in your line, which will never happen again in the generation of reports.
They replace the page.
Yeah, it says actually fire total teachers targeted. They did this to actually every single board, and it's a typo. However, the individual managers, we can go through the executive session because the breakdown of the PPAR, the RBC Access that we would normally show you is actually in some of the more executive materials, unless you want to refer to the public book and for the month. We're working on correcting that. It was one of the things we didn't coordinate well. For the PPAR, just to note, fire purchased over $800,000, almost $900,000 worth of loans to create or preserve 556 units in the second quarter. You also made forward rate locks for about 1,430 units of housing, about $2.3 million. So we'll see those coming to us over the next 2 years. If we go to the next page, page 10, where AFLO CIO hit. From our portfolio actually outperformed its benchmark by 50 basis points in the second quarter and 38 basis points over the last 12 months. The last time I was here, you'll note they underperformed by 3 basis points, and I told you that we expected to go up because of how disciplined they have been in the past, how well they keep to the Barclays Ag. We're very happy that they're doing that. And actually AFLO didn't make a lot of new loans in this quarter, in part because they're getting ready to make a large new commitment. And last, on page 12, RBC Access also, which does our single-family investing, did not make any significant loan purchases in the third quarter. They did underperform by 3 basis points, but in this second quarter, but over the last 12 months, they're up by 118 basis points. And that's it for me, and I can always swing back if people would like me to put more color on the individual returns in the executive session. I'll turn over to my good friends in private equity.
Thank you, Brian. And we're going to be working off this book again, the Total Fund Overview book, and I'll turn you to page 23. As a reminder, private equity reports on a lag, so we will be reporting on first quarter results ended March 31st, 2015, and I will turn it over to Inosh Kadela on our team to walk you through the results for the quarter.
Thank you, Alex. Good morning, everyone. So I'll be walking you through our private equity quarterly report for the first quarter, which begins on page 23 with the total portfolio overview and performance. So as of the first quarter, the total private equity portfolio had a market value of approximately $763 million, which represents 7% of the total FIRE plan. And in addition, the unfunded commitments were about $470 million, which results in a total exposure of $1.2 billion to the asset class. As of March 31st, the plan's since inception net IRR was 11%. And now I'd like to turn your attention to the agenda package, which is the thick book, for a more detailed look at the quarterly results. This book over here.
Yes, you got it, sorry.
And we'll begin on page 26 with a snapshot of your portfolio and your quarterly performance. So looking at the top of the performance summary table, you can see that as of March 31st, FIRE had $1.4 billion in active commitments across 103 managers and 161 funds. And if you look at the bottom of the table, you can see that the portfolio's since inception net IRR increased by 7 basis points quarter over quarter to 11%. and the net total value multiple increased slightly to 1.38 times over the quarter. If you take a quick look at the prior page, page 25, we can review the quarter. So within cash flow activity, during the first quarter, the portfolio was slightly cash flow negative by about $6 million as contributions exceeded distributions. But the portfolio has been cash flow positive in 4 of the last 9 quarters. Within the recent portfolio activity, you'll notice that both quarter over quarter and year over year, the portfolio value has increased net of cash flow activity. Over the prior quarter, the portfolio value increased by $24 million, or about 3%. And over the prior year, the portfolio value increased by $73 million, or about 11%. Next, under the new investment commitments, you'll see that FIRE closed on 2 commitments during the quarter, $19.5 million in aggregate to 2 managers. And subsequent to quarter end, through August 25th, FIRE closed on an additional $58.8 million to 5 managers, which includes 2 emerging managers. Let's take a quick look at page 28 to review the portfolio returns over various time periods and against the relevant benchmarks. So since inception, the portfolio has generated an 11% net IRR, which lags the program's benchmark by 240 basis points. The program's benchmark, just as a reminder, is the Russell 3000 plus 300 basis points. On a 1-year basis, the portfolio generated a 10.7% net IRR, which also trails the program's benchmark, which is due to the continued outperformance of the public markets. However, given that private equity is a long-dated asset class, we believe that the since inception figures are the most relevant. On the bottom of this page, you'll see the portfolio's performance broken out by strategy, and you'll find that the large buyout, secondaries, special situations, as well as growth equity continue to outperform FIRE. And lastly, I'd like to turn your attention to page 35 to review the geographic diversification. And based on current market value at the bottom of the page, North America represents the largest exposure at 79%, Europe is at 16%, and the rest of the world is at 5%. We also break out New York State and New York City exposure here, and in terms of exposed market value, 7% of the FIRE portfolio is exposed to New York State companies, and of that, 6% is exposed to New York City-based companies. Are there any questions?
Before you go further, I just want to note that Ms. Susanna Vickers is now present in the meeting. Emphasis upon Ms., of course, for the previous mistakes.
Great. So with that, I'll turn it over to real estate.
Hi, good morning. So we're going to review the real estate performance in the same manner. We're going to go back to the small book, spiral book, to page 27, which has a snapshot of the real estate portfolio. And at the top, you'll see a historical snapshot of activity. The market value of the real estate portfolio is $435 million. It represents about 4.1% of your portfolio at this time. You have nearly $675 million in commitments. Of that, $541 million has been contributed. We've also had $242 million, which was distributed back to us via the managers. And this investment activity has produced a since inception net IRR of 6.6%, 1.25 net equity multiple. And now we're going to move back to the bound board book, page 43 of your agenda book. We'll continue to talk about the real estate portfolio. So we're back, now we're going back to this book, page 43. And from this point point onward, I'll refer to the page numbers that are at the bottom, so you'll see that this is page number 1. And real assets has an allocation of 5% for fire, plus or minus 2% for rebalancing. And that allocation is about $546 million. As of the first quarter of 2015, we talked about the market value being $435 million, or 4.1% of your portfolio. At that particular point, there was about $145 million in commitments yet to be funded. So fire's exposure to real estate is $580 million, or 5.3%. In terms of performance, the performance for the quarter was 2.8% on an after-fee basis. This trailed our benchmark by 60 basis points. As you can see in the graph in the lower right, it shows the performance against the benchmark over various periods. The portfolio exceeded the benchmark during the 1-year, 3-year, and 5-year period, so a very strong rebound post-recession. And again, the since inception return of the fire portfolio was 6.6% and a 1.3 times net equity multiple. Going on to page 2, what I want to direct your attention to here is that the portfolio is skewed right now toward non-core strategies at 65%, but we continue to identify core and core plus strategies to balance this out. And as you may recall, over the past couple of months, we've made commitments to very strong core plus managers with Premier and Artemis, and we'll have another new core plus deal to talk to you later on in the agenda. The cash flow activity for the quarter was positive, where distributions from the managers, particularly those non-core managers that we just talked about, outpaced the contributions made. So we got $36 million in distributions, and we paid out 23. So I like that. Just skipping over to page 5, just to give you a sense of how the portfolio looks in terms of diversification by property type and geography. The portfolio is well diversified. We are about close to approaching 15% in terms of our ex-US exposure. This is a global portfolio. And also, for those interested in tracking our activity here in our own city, the exposure to New York City is currently 11.8%. The agenda is quite full of real estate matters, so I can take some questions now, but we're going to be talking more about real estate later. Yes, John?
Yeah, so just on the portfolio composition. So we're at 35.4% core, right? And the requirement is a minimum of 40%. Is that right? So we're out of compliance with our composition?
We are. We are, and we note that in this report.
Yeah.
And when we talk about some of the specific investment recommendations later on in the program, we note it in every report.
You note it, I'm sorry, I missed
Note that it's overlaid.
Right. Okay, thank you.
So Scott, over there.
Good morning. Very briefly, because the program is still in very early stages, so my remarks would be brief. But if you can please go back to the book that is Total Fund Overview, page 27. Similar to my colleagues, we are reporting on the quarter that ended on March 31st. And you can see the third line from the top down. There are a few numbers about infrastructure. So the market value for that quarter was $7.2 million. And the net IRR was 14%, 84. And with that, I would like to go now to the big room, big book. It is on page 53, where the report by our consultant starts, and we'll go directly to page 57. On that page, what you see is the performance of the program to date against the benchmark. The benchmark, again, is CPI plus 4, so it changes. And at that time, for the third quarter, the benchmark was 5.6%. Again, the IRR is 14.8, so well in excess of the benchmark, but it's too early in the program development. So the program is developing well, but still too early to really say with confidence that that it is going to be the end result. If you now please move to page 66. You would see the geographic composition of the portfolio, and North America represents approximately 62% of the portfolio, with the remainder allocated to Europe. In terms of sector exposure, the renewables are the sector that we are currently invested the most, with highest exposure, 52% approximately, followed by transportation with 17% and energy 16%. I would also like to draw your attention to the next page, 67, where you have the risk management matrix. And there you could see that the program is in compliance with different metrics in the portfolio in terms of asset type and location, strategy diversification, and also importantly, the program is in compliance with the leverage parameters. The leverage according to the program is 65%, and the currently program is at 36.6. So overall, again, the direction is good, but it's still early stages. With that, yeah. No, I was just going to conclude. Yeah.
Thank you very much, Petra. That concludes the quarterly public reports. We'll have some more details for you in the executive session. Why don't we turn now to the July monthly performance review, and that is in the lookbook that we typically use, the one that does not have the bindings in it. You don't have it? Is that it over there? Let's turn first to page 39. And I'll give you the bottom line here for July. Right? So we just talked about the information through June. Now we're going to give you July, page 39. And let's start with the fiscal year that we just looked at. 1, 2, 3, 4, 5, 6, 7. The seventh column over, it starts FYE 6/30/15. Go all the way down to the bottom, where it says total fire, and it's 355, not the 329. So it's gross of fees, not net of fees. And I'm just doing that to sink in the numbers that you're looking at. So this is the gross of fees number. We swing over here to the 1 month trailing. You can see the total fire was up 46 basis points versus 69 on the benchmark, an underperformance of 23 basis points. Go to the asset allocation mix on page 32. We can see that we're attempting, at page 32, we're attempting to hold the adjusted policy weights that we've been talking about for some time now, more or less equal weight in the equity section in the left, and on the right, we've gone underweight structured in inflation linked and overweight short-term securities in gray to get to an overall interest rate sensitivity similar to the Barclays Ag. In the quarterly books, we have the specific numbers for it, but it's right on the Barclays Ag in terms of interest rate sensitivity. Turning to the environment that we're in on page 18, and these charts are updated through the 8th of September because there's been so much action in August. I figured rather than going in detail through July, we could just cover what's been going on over the summer. You can see that the volatility index, after traveling at very low levels, this is a gauge of the anxiety in the markets. It has to do with the implied volatility in the futures markets, but it generally gives you a sense of how comfortable with risk market participants are. And you can see in 2011 they got very concerned. This is when there was turbulence in Europe. We've seen turbulence recently in Europe, and particularly the spike that went all the way up to 40 during August related to China, to a currency revaluation in China that was unexpected. Some growing doubts about the consistency of the economic numbers that are coming out of China, and general angst about China. It's incredibly important to the world's economic growth, and we have sort of spotty data. That was exacerbated by some remarks that have come out of China recently, after first reacting to this by trying to use public funds to invest in their markets, work on their currency policy, et cetera. And now they're rounding up leaders of the brokerage firms. And the guy from CITIC was just charged the other day, and they're trying to keep brokerage firms to keep from selling. This is a rather unhelpful approach, in my opinion, at least in the market's opinion, to managing their circumstances in a capitalist market. And so this level of angst will remain for a while. I don't think it's going away soon. In September, the Chinese government began to make more assuring statements about their currency policy, that they were not trying to devalue the renminbi, and the markets have cooled off a little bit. I don't think this is going away. I think I think we're going to have some uncertainty, and then uncertainty has led to some pretty significant changes in prices. You can see the oil price on page 17, which is happening in a somewhat reflection of the dollar, but also the supply and demand of oil, which is linked to the resource demand in China and in the developed world. The oil price is just going to extremely low levels. It's popped up recently to $45, but that is putting stress as well and causing a lot of relative prices. So we've gone from an environment where nobody was getting paid to take risk to an environment where suddenly, as people perceive risk, as you can see from the volatility index, now when we look at valuation on pages 21 and 22, we can see that securities prices are beginning to change to pay us to take risk. And although we suffer an immediate hit in terms of the value for the securities that we held, when we get cash flow from the city and from pensioners and we put them to work, now we're putting them to work in risky assets in a way that we can get paid for it a little better. You can see this in the high yield bond market up on page 21. The red line is the extra return that you get for taking risk in high yield bonds versus treasuries, now 544 basis points. More normal and a reversal of the decline that's been happening over the last 3 or 4 years. You can even see in the investment grade a slight tick up in the price that you're getting, the premium that you're getting for taking default risk in investment grade bonds. You can see quickly in the bottom here on page 22, the PE effect for the S&P 500 in white. You can see that as we've gone towards the end of 2015, and particularly over the summer, the PE has gotten down to much more modest levels, and so you're able to buy equities at more reasonable prices. We have a couple pages of additional PE data here on 23 and 24. You can look at those at your leisure. We turn to page 25. You can see quite clearly the relative patterns of equity behavior between the U.S. market, as marked by the Russell 3000 index in white, the developed markets, a little tough to see in orange here, working pretty much in parallel. But the thing that's really happened over the course of the spring and the summer is emerging markets have really fallen off on a relative basis. And so the values in emerging markets have gotten to very healthy levels relative to the developed world. So U.S. and Europe, the values are getting better. And the emerging markets, the PE multiples are quite modest. So what's this mean to us? We're not big tactical allocators trying to shift the money around and try to take advantage of prices. But what do? We rebalance. We stay to a consistent exposure over time. So when assets are getting revalued and they go to low levels and the prices get more modest, we automatically buy more of those. When assets go to very high levels because people are getting enthusiastic, we automatically lighten up. So rebalancing actually has a very sensible, practical effect on the portfolio over time. And it's often buying securities when it's the most difficult to buy them, when it's tough to kind of emotionally come over the concerns in the marketplace. So we are in fact running that same strategy and keeping you close to our long-term returns day in, day out in the marketplace. And as we go through this volatility, if you have directionless volatility, rebalancing will actually pay very handsome dividends over time. I think that's about all I wanted to say for the monthly update. I'd be happy to answer any questions before we get into our trustee education portion of the presentation.
When you say emerging markets, is a specific part of the world?
Yeah, so emerging markets the U.S. is measured by the Russell 3000. IFA, Europe and the Far East are Western Europe, Japan, etc., the major developed markets. Emerging markets are going to be Brazil, China, and so forth. And so we have an exposure to emerging markets. It's much less than it is to Europe or to the U.S. But we keep a consistent exposure to all these different markets over time. Okay, questions? Okay, good. Why don't we then turn to the trustee education portion of the session. We're very happy to have Mike here Mike Garland to talk about the Corporate Governance and Responsibility Group, and I'll turn it over to him.
Good morning. I'll make a couple just quick remarks while those are getting handed out. So this presentation is really to provide an overview of the Corporate Governance and Responsible Investment Program. Members of the Proxy Committee, particularly long-standing members of the Proxy Committee, are probably fairly familiar with this. I'm not going to go into specific initiatives, but I don't think, certainly in recent memory, there hasn't been a presentation to the full board on the program. I've been here 5 years, and I think this is my first time addressing the full board, and I also know we have some new trustees. So I will be reporting to the proxy committees hopefully next month on some initiative updates, and happy to come back to the full board if there's interest. Does everybody have a copy of the presentation? So I'm going to start on slide 1 and just give you a sense of what we do and why. First and foremost, we fulfill your fiduciary duty, the fund's fiduciary duties with respect to proxy voting. If you looked at the asset allocation, roughly half your portfolio is in public equity, 2/3 of that U.S. public equity. You hold, via your investment managers, nearly 3,500 U.S. companies and almost as many non-U.S. companies. Every meeting, certainly in the U.S. and generally globally, holds an annual meeting every year to elect directors, to approve executive compensation, to vote on shareholder proposals. Each share has a vote. Those votes are considered plan assets and must be exercised in the best interest of your participants and beneficiaries. That's certainly the interpretation under ERISA for private pension plans, and I know public plans generally look to ERISA for understanding their fiduciary duties. In addition to voting those proxies, which we do based on guidelines approved by the proxy committee, we also actively engage portfolio companies. And really this is the basis for all of the shareholder initiatives. Your fund is truly a long-term owner. I mean, essentially a permanent owner of virtually the marketplace. And it's both because your time horizon, which as you know is decades, but also your investment strategy. I don't know the exact number, John, but my guess is over 80% of your at least U.S. public equities are invested through the index. So you or your investment managers can't sell a company just because you're concerned about the board or the management or particular business practices. So the only way to protect or create value is to actively engage those companies. And so we do that to strengthen governance and promote sustainable business practices. So the core responsibilities, we vote proxies, we engage companies, both what I would say routine engagement just around proxy voting, and more formal share owner initiatives and advocacy through shareholder proposals and other advocacy efforts. We collaborate with our institutional investor peers, both here in the U.S. and more outside the U.S. We also engage with regulators, the Securities and Exchange Commission, around reforms, the stock exchanges. And then finally, we're a resource both to the boards and the rest of BAM on broader responsible investment activities. And I'll touch on that a little in the presentation. We have an 8-member team. We recently made a senior staff addition, Scott Drazel, who's here as the Director of Strategy and Corporate Engagement. Scott previously ran the corporate governance program at the Amalgamated Bank. So he has subject matter expertise. He also has a lot of good relationships within the institutional investor community. So it's a great addition to the team in terms of doing more and more effective work. On slide 2, I've walked through this slide already when I talked about why we do what we do. And just to underscore the point, we can't do the Wall Street walk what other investors do when they walk away. And so we do actively engage. At minimum, to manage risk, we think our activities help to create value, but it's always easy to find the counterfactual. A company, Enron, a weak board and the destruction of value, or Massey Energy, the failure to manage human capital well and that destroyed both human life and shareholder value, or the BP disaster. Going on to slide 3, from 10,000 feet, or the kinds of issues we engage on, nothing is more important than the board of directors. Historically, we've been focused on the independence of the board and making sure they can be held accountable. I think we're evolving to looking at the quality of the board, the diversity, both in terms of skills and experience, race and gender. Is it the right directors who collectively to oversee the company? And then we also look at the structure and levels of executive compensation, workforce diversity, worker and human rights risk, climate change and other environmental risks, and disclosure of corporate political spending. And the funds have, FIRE and the other funds have long been active on all of these issues. If you turn to slide 4, it's just a chart trying to show you the continuum of active ownership by U.S. pension funds. And your fund and the New York City systems collectively are far to the right here. I mean, we are one of the most active, and I think not only do you actively engage companies and vote your own proxies, you submit shareholder proposals from time to time. We lead campaigns against the election of directors, may serve as lead plaintiff in litigation. That last box, running director candidates, is something that we haven't done, no fund has. I think that's the next frontier, and based on an initiative we're doing this year, I think on a very limited basis, that's a place we hope to get to in the near to immediate term. And to underscore the point when I say we're among the most active, in terms of filing share owner proposals, if you looked over time, there's no pension fund in the U.S. who submits more. And volume shouldn't be the sole measure. It's quality of what your and output, but we certainly are the or among the most active. Slide 5, we have a commitment to leadership and collaboration, both among the funds. So most of our share owner initiatives are done collectively, the 5 funds, and with other systems. The 5 systems collectively were probably the 4th biggest public pension fund system in the country. You rarely hold more than 0.5% of any company, and it's pretty consistent. So you own about between 1/4 and 0.5%. The dollars are huge. On a company like Apple, it's over $1 billion, but our voice alone, it's hard. We try to hit above our weight class by collaborating with other investors, and there's a long history of that. Controller Golden was a co-founder of the Council of Institutional Investors. We're members there. I co-chair the Activism Committee. Controller Holtzman was a co-founder of Ceres, which we're active there as well, and Controller Stringer sits on the board. Obviously a long history of shareholder proposals and advocating for specific reforms. A leader, for example, pushing the McBride principles to protect against workplace discrimination in Northern Ireland, sexual non-discrimination proposals. Some of our current work, we're an active participant in collaborative efforts with other investors around human capital. So not just worker rights and human rights, but how do companies think about their workers as an asset to be valued and maximized, and not just a cost to be minimized. And we're not actually advocating for anything particularly there. We're really just talking to a set of companies to better understand what are the right metrics to measure and how do we evaluate those practices. Carbon Asset Risk Initiative, we're part of a very large group of investors engaging a very large number of global fossil fuel companies, oil and gas, coal, and utilities, to assess and do scenario analyses under various scenarios for trying to maintain global warming to 2 degrees Celsius and what that means. So to make that a little more, to bring that down into the weeds a little, if you're Exxon and there's a global price on carbon, how does that affect your long-term business plan? And if there's no global price on carbon, what are the physical risks of climate change you may face? For example, your largest refinery might be on the Gulf of Mexico, and if the sea rise, is that facility jeopardized by climate change? And I will go into this. I know some of you have heard a presentation several months ago, and the proxy committee is aware of it. We'll get an update. But the Boardroom Accountability Project, which is really something we have led, but we've also done it in partnership, formally and informally, with a number of other large funds. We're essentially advocating for a particular right across the marketplace called proxy access, which would allow substantial long-term investors the right to nominate directors and include those nominees on the same ballot that the company sends out to all shareholders. It's been one of the most successful initiatives, I think, that we have led, and really one of the investor-led initiatives. It's a reform that, at the regulatory level, New York City and other investors have been fighting for since the collapse of Enron. And the SEC has twice put forward a rule. They actually enacted a rule in 2010, but the Chamber of Commerce sued and overturned it. So that rule would have given us this right at every company. We now have the right to ask for the right at every company. We don't have it mandated, and we're having tremendous success. If you go to page 6, these are just some headlines from the past several months. I will be giving a much more detailed update on the initiative to the proxy committees in the fall, but the landscape has changed dramatically since we launched last fall. There were probably fewer than a dozen companies with meaningful proxy access last fall. We believe there's now upwards of 50 companies that either have meaningful access in their bylaws or are contemplating putting that in place. Finally, slide 7, some of the broader activities that we are either responsible for or a resource for. We provide assistance to the boards responding to various surveys around responsible investment. The Asset Owner Disclosure Project is something that evaluates some of the larger systems. So NYSERS and teachers are automatically evaluated, so we help complete the surveys. NYSERS is a member of the UN Principles for Responsible Investment. Responsible contractor policies, those boards that have them, we're working to assess and benchmark the policy with peer best practice and working with updating that policy. We believe having a good responsible contractor policy in place can mitigate investment and reputational risk by defining expectations of fund managers for labor law compliance and provision of fair wages and benefits, and provide a roadmap for the stakeholders under the policy for our various roles. We also help interpret the results of the ESG questionnaire that goes out to investment managers and work with them to review those as well. So that was sort of flew through the overview, and I'm happy to answer questions.
Question here.
On the last bullet point, the investment manager ESG questionnaires, those are currently being sent out, or are they something you guys are working on? And then 2, are they, I guess, tailored by asset class or by kind of, versus obviously our equity managers would be kind of a much more kind of developed and say like a high yield manager that's going to invest a lot of energy and so forth. So just kind of wondering with those 2, are they tailored, and then also is this currently being sent out, or is it?
So let me answer to the extent that I can, and then also rely on some of my colleagues. So I'm most familiar with the public equity questionnaire, and I understand there hasn't been a new search in...
The last search was IFA, which was
a few years ago. So the IFA search. So the last time there was a search, the questionnaire was sent out, and our team did evaluate those responses. And I invite others to weigh in. My understanding is other asset classes have either implemented or are evaluating how to implement a set of questions, but I'm not equipped to respond.
Any other questions? Okay. Thank you. Thank you very much, Mike.
Thank you.
Just turn quickly to an asset allocation update. I'll make a couple comments and ask Doug Mosley to chime in with anything that I've missed or to add something. We are meeting with Doug and NEPC currently, as I'm also meeting with the other 5 consultants that serve the other 4 consultants that serve the other boards to evaluate our asset allocation and to come back to you with reports and to set up discussions with this board to periodically evaluate the asset classes that we're using. And what we're doing is based on NEPC's expectations for the various markets over the next 7 to 10 years. We're evaluating pairwise trades, in other words, out of equities and into long-term bonds, or out of private equity and into real estate, that might improve the risk-reward structure of the portfolio over the next 7 to 10 years. And we'll evaluate whether we ought to tweak the asset class percentages that we stick to over time. And that'll be the whole discussion. We'll have at least one session. We can have as many sessions as you feel are necessary to go through this analysis. We're also going to attempt to give you some better information about the effect of the downside scenarios for each asset mix that we might use on the overall health of the pension fund in terms of the long-term obligations that we have. We're not going to get into deep discussions about assets and liabilities and funding ratios, et cetera, but we will attempt to show you what the downside scenarios might look like in terms of the impact on the portfolio and the impact on the contributions to the portfolio. So we're in pretty good shape on this. We've had one group meeting with all the consultants. We've met with Doug and his team privately. We're currently scheduling a second meeting with Doug and his team to go over some of their preliminary numbers. And so we're still pretty much on plan to be able to have a vigorous discussion by the end of the year. Doug, did you want to add anything?
No. We're also working with the actuary as well, the
Correct.
state, so they're getting data from
Yeah, and I neglected to mention Sherry Chan's involved, and she'll be involved in that risk calculation that I mentioned. She's the one with the numbers. Okay. Mr. Chairman, that concludes our public comments for the qualified pension plan. We do have the VSF to talk about.
Well, I think we need a motion to move out of this public session and close this part of the meeting and go into the firefighter variable supplement meeting. We need a motion first of all.
Motion to adjourn the public session of the pension plan, which is the public session of the variable supplement.
Second.
Any objections? Hearing no motion carries. We need a roll call of trustees.
Mr. John Randall?
Yes, present.
Ms. Susanna Vickers? Here. Mr. Antonio Rodriguez?
Present.
Mr. James Levin?
John Kelly has James Levin's proxy.
Mr. Eddie Brown?
Eddie Brown, too.
What happens if there was in a farm when they start the meeting?
Okay. Performance reviews.
Have those been distributed?
Yes.
Everybody has to get that? Okay.
All right, so we're in the VSF meeting now?
That's right.
The fire fighters or fire officers?
Firefighters.
Firefighters.
Okay, so you have in front of you the total fund overview for the firefighters variable supplement fund, and I can take you through the details if you want. I know it's been a tradition not to go into details, but I'll leave it to you if you have any issues or questions.
Does the board want to go through the details?
Note the outperformance is kind of a...
Do you want to go through the details of this? It's structured in the same way that we've structured the other portfolios. If you turn to page 9, you can see that fiscal year to date, for the fiscal year 2015, net of expenses up 44 basis points, up 2 basis points over the 3-month period. And then you have the asset class information below on page 9 and 10. And although some of the holdings are different, many of the comments would be similar to the comments that you got at the general session. Do there any questions?
Any questions? So if there are no questions, we need a motion to move out of this public session and adjourn the firefighter variable supplement meeting and start the fire officer variable supplement meeting. Any objections? Hearing none, motion carries. We need a roll call of trustees.
Mr. John Adler? Ms. Susanna Vickers? Here. Mr. Antonio Rodriguez?
Here.
Mr. James McGowan?
Here.
Mr. John Farina? Here. We'll have the full votes in the forum. We'll start the meeting. Public session.
Okay, I'll turn then to the firefighter officers variable supplement fund total fund overview, page 9. And you can see similarly, but not exactly the same, during the fiscal year, 47 basis point outperformance net of fees, and a 10 basis point underperformance net of fees for the 3-month period. Do you have any questions?
If there are no questions, we'll take a motion to move out of this public session.
We accept the report.
Pardon? So,
We accept the report.
you accept the report? Do you have a motion as well?
So
Is there a second?
I second.
Any objections? Hearing none, motion carries. Okay, so now we can, we need a motion to move out of the public session and of the New York Fire Department Pension Fund meeting to move into executive session.
Second.
Any objections? Hearing none, motion carries. We're now in executive session.